In this presentation, I want to talk about the disadvantages of treasury notes. I've earlier spoken about the advantages, the benefits. This time around, I want to consider the disadvantages of investing in treasury notes. Number one is low yield, due to their low risk nature. Treasury bills typically offer lower yield. So you have to balance the safety and the yield. Higher level of safety, but lower level of yield. Unlike what is obtainable in corporate bonds or stocks. So it makes them less attractive for investors who are looking for high return. You want to make high returns and you can stomach the risk and the fluctuation, you should invest in stocks. That will give you a higher return. But if you prefer safety, you don't want to bear the risk and the fluctuation involved in stocks, then treasury notes is a very good candidate for you. Number two is interest rate sensitivity. Treasury notes are subject to interest rate risk, just like all securities from this particular nature. The bond category, the bond class. You discover that the return is always a factor of the prevailing interest rate. So if interest rate rises, the bond value or the existing value of the treasury notes will decline, potentially leading to a capital loss for investors who want to sell before maturity. Well, if you don't sell before maturity, there's no problem. But if you want to sell before maturity, then the fluctuation in interest rate will certainly eat into your return. It will affect the kind of returns you are going to get. Number three is inflation risk. You will discover that the interest payment from the treasury notes may not be able to meet up with inflation. Sometimes inflation may eat into the kind of returns you're having. Let's say you make a returns of maybe let's say 9%, and the inflation rate is 11%. You discover that you're not really making a tangible gain as such. So there's that risk that inflation would eat into your returns, and then the purchasing power of the returns you're making may not be able to meet up with the pace of inflation. Number four is taxable at the federal level. While they are exempted from local government and state taxes, you discover that you realize that the federal government will tax these instruments. So it's not tax-free at all. The federal government will take their chunk of the returns you are making. So this will reduce the after-tax returns you're making out of the investment. Number five is opportunity cost. The relatively low yield is a real cause for concern, because generally as an investor, when you invest in a particular vehicle, that money could have been invested in another vehicle that probably would yield something higher. And so the opportunity cost of you investing in treasury bonds and treasury bills, or rather treasury notes, and be collecting these small kind of returns is really high, and so you should take it into consideration, because you will miss out on the higher returns from riskier assets like stocks and high yield bonds. You're pursuing safety at a lower risk, at a lower returns, instead of pursuing something risky but at a higher yield, at a higher return. The choice is yours anyway. It's just a matter of your natural propensity to bear or not to bear risk as an individual. Number six is it's not suitable for high growth investors. If you really want high growth, this investment, the treasury note is not for you. It's not for you. You know, for those who are seeking high, growth opportunities, as they offer limited capital appreciation, potentially compared to equities and other growth-oriented investment. You don't really buy treasury notes for capital appreciation. You don't get to, your money hardly ever appreciates compared to what you can obtain in the stock market. Number 7 is a reinvestment risk. The treasury notes mature. When the notes mature, actually, investors may face reinvestment risk if prevailing interest rate is lower than the original yield, potentially reducing their returns. If you want to sell, you want to sell your position, you want to sell your investment, you discover that you stand that particular reinvestment risk. Even the interest rate goes against you, all right, you sell when the interest rate is high. That means you are selling at a loss. And if you want to reinvest again, it may not really favor you as it ought to. So there's that reinvestment risk. Number 8 is limited capital gain potential. While treasury notes can be traded in the secondary markets, that's the liquidity aspect of it, their prices changes or the price change, the price fluctuation is less than what is obtainable in stocks. And for that reason, you discover that there's lower limited opportunity for capital gain potential. It's lower potential for capital gain. In a typical stock investment, your stock can increase by 5, 10, 20, 30, 40, even over 100%, but you don't expect that kind of returns in treasury notes investment. It's not possible. So that's limited capital gain potential. Number 9 is there's no hedging against deflation. There's no hedging against deflation. Unlike inflation-protected securities such as some kind of bonds, treasury notes do not adjust for deflation, so investors may not benefit from rising prices in a deflationary environment. Prices are rising, but you can't gain from it. You cannot benefit from it. Please like this video and subscribe to this channel if you've not done that. Number 10 is longer duration risk. Longer duration risk. For treasury notes with longer maturity, those with 7 to 10 years, the risks associated with changes in interest rates and inflation becomes more pronounced, which may affect the total returns over time. So the longer you hold the investment, the longer the level of risk, or the higher the level of risk you are exposing yourself to. So these disadvantages make treasury notes less attractive for those seeking higher yield, higher returns, capital appreciation, capital gain, or those who want to be protected against inflation, though they remain a solid choice for conservative investors prioritizing safety over income. This particular vehicle is more of a capital preservation investments than a return than a higher return giving investment. You want to preserve your capital at the expense of obtaining higher returns, then you can go ahead and invest in treasury notes.